Everyone thinks the Bank of England was founded to stabilize money, but the truth is, it was created to fund war. More specifically, to fund a war the English crown couldn't afford, using money the government didn't have, borrowed from men who barely existed on the official balance sheet. You've probably heard that central banks were invented to manage inflation, to keep economies stable, to act as lenders of last resort. But in 1694, the Bank of England wasn't created for the people. It was created for the lenders. This wasn't about helping the nation, it was about saving the monarchy. Because England, in the late 1600s, was broke. Not metaphorically, literally. Decades of war with France had drained the royal coffers. Creditors no longer trusted the crown. And without trust, there's no money. Here's the paradox. In a country where the king had no silver left, where gold reserves were thin and tax revenues shaky, somehow a group of financiers managed to lend the government £1.2 million at 8% interest. In return, they were granted the most powerful charter in British economic history. They were allowed to lend money that didn't exist yet. You might think this is just a historical quirk, a footnote in financial history. But look closer. This was the birth of a rule, a quiet one, almost invisible, that still governs how modern credit works today. If you have a mortgage, a student loan, or even a savings account, you're already living under it, a rule that says private lenders can create public money and be repaid with interest, enforced by the state. It started not with coins, but with paper, not with wealth, but with promises. And it worked, not because the people trusted it, but because the government had to. Once this rule was in place, war could go on, interest could compound, and for the first time, a modern state had outsourced the creation of money itself to a private entity. The Bank of England was born not to hold money, but to manufacture it in the form of government debt. And if you're wondering how we got from there to here, just wait, because the logic hasn't changed, only the packaging has. If this already flipped your understanding of history, comment with the country you're watching from. Let's map the reach of this 300-year-old idea. To understand how a simple rule in 1694 reshaped global finance, you have to step back into a world that feels distant but functions almost identically to ours. Because the mechanics that built the Bank of England weren't invented in a marble hall. They were born out of desperation, improvisation, and a quiet partnership between a cash-starved government and a rising class of lenders who understood something the monarchy didn't. Money is never about metal. It's about power structures. Picture England in the early 1690s, a country locked in a grinding war against Louis XIV of France. The crown needed ships, soldiers, supplies, but the treasury was dry. Gold reserves were nearly gone. The mint was barely functioning. And the government's biggest problem wasn't the enemy abroad, it was the creditors at home who had stopped lending. Think about that. A state can survive famine, disease, even military defeat. But when lenders refuse to extend credit, the state stops moving. It becomes a body without blood. This was the crisis the newly installed King William III inherited after the Glorious Revolution of 1688. The monarchy had been weakened, Parliament was asserting new power, and public finances were in chaos. England's national debt, a term barely used at the time, was already spiraling, and new taxes weren't enough to keep the war machine running. So Parliament tried the obvious solutions. They issued lotteries. They sold annuities. They borrowed from goldsmith bankers. But the lenders demanded higher and higher interest rates, 15%, 20%, even 30%. Because lending to the English state in 1693 was basically lending to a man standing on a sinking ship. Then came a proposal from a Scottish trader and projector named William Paterson, a man who understood the future of money better than the politicians he approached. Paterson's insight was simple but revolutionary. The government didn't need gold, it needed credibility, and credibility could be manufactured. Paterson and a circle of wealthy merchants proposed a deal. They would lend the government £1.2 million, a massive sum at the time, at 8% interest. In exchange, they wanted a charter, not just any charter, but a legal creation that allowed them to form a new corporation, a corporation that could do what no private lender had been officially allowed to do before: issue banknotes, backed not by gold, but by the debt of the government itself. This is the moment the system was built, the moment debt became money. The lenders understood the trick. If the bank lent money to the government's IOU became an asset on the bank's books, and against that asset, the bank could issue notes to the public, paper backed by promises, promises guaranteed by Parliament, Parliament funded by taxpayers. It was a closed loop, elegant, circular, and astonishingly profitable. The Bank of England's charter was granted in July 1694. The rules were simple, but the implications were immense. The bank would deposit the £1.2 million loan into the Exchequer. In return, the bank received the right to issue an equivalent volume of banknotes. Those notes would circulate as money. People would accept them because the state accepted them, and the state accepted them because the law said so. This was the birth of the 1694 rule. Private credit can become public money when the state guarantees it. You might think this is dry financial architecture, but it's the blueprint still running every major economy on Earth. When your central bank buys government bonds today, it's using the same loop Patterson designed, only scaled 1,000 times larger and wrapped in modern language like open market operations. Back in the 1690s, though, this was nothing short of economic engineering. It allowed England to continue the war. It allowed the merchant financiers to collect interest backed by taxes. And it established a permanent national debt, not as a temporary wartime emergency, but as a structural feature of the economy. Imagine being there at the founding meeting. Ink on parchment, candles flickering, men in powdered wigs debating rates and privileges. None of them could have predicted that their signatures would create an institution that would finance an empire, dictate the flow of global credit, and become the model for every modern central bank from Paris to Washington to Tokyo. But you and I, looking back, can see the pattern clearly. A government in crisis handed over its most powerful tool, money creation, to a private group in exchange for survival. The lenders accepted because they knew something timeless. When states borrow, lenders rule. By the end of 1694, England had its war funded, the merchants had their bank, and a new financial world had quietly emerged. One where paper could command armies, interest could outlive kings, and the national debt would never again return to zero. Because once you build a system on credit, you can't unwind it without tearing the system apart. If this helped you see the foundations of modern money with new clarity, let me know where you're listening from. The ink was barely dry on the Bank of England's charter when something strange began to happen. People started using the bank's paper notes, not just to buy things, but to store value, to settle debts, to do business. What was once just a promise to repay a government loan became in practice money. And almost nobody stopped to ask what exactly was backing it. They didn't need to, because the war continued, the taxes flowed, and the machine worked. At least, it looked like it worked. Here's what most people missed. This wasn't just about the Bank of England. The real innovation wasn't the paper. It was the structure behind the paper, a loop of trust, law, and interest. For the first time in English history, the economy had a central anchor that wasn't tied to gold in a vault, but to debt on a ledger. And that debt could grow, which meant the money supply could grow, which meant the illusion of endless liquidity had begun. This was the era of financial acceleration. Between 1694 and the mid-1700s, England transformed from a middling European power into the central node of a new kind of empire. Not just an empire of colonies, but of credit. And the Bank of England was its beating heart. Every time the government needed money, another war, another fleet, another treaty, the process repeated. Parliament borrowed, the bank issued notes, credit expanded. In theory, the bank had to hold some gold and silver to back its notes. In practice, that ratio became looser and looser because people believed in the notes. And as long as they believed, the notes didn't need to be redeemed. Here's where the illusion sets in. The economy boomed not because productivity had skyrocketed, but because credit had. This was new. Before, economic growth was limited by real inputs, harvests, mining, land. Now it could be driven by leverage. Need to build ships? Borrow. Need to fund trade? Borrow. Need to colonize India? Charter a company, issue shares, borrow. By the early 18th century, London was filled with financial instruments most people didn't understand: promissory notes, bills of exchange, early stock certificates. The East India Company, backed by the Crown and the Bank, began functioning as a private government hybrid, raising money like a bank, governing like a state. And everyone believed the machine would never run out of fuel. After all, the Bank of England could always expand the balance sheet, just print more notes, lend more to the government, let the interest payments roll in. It was a perfect circle, until you remembered what sat at the center: debt, a growing pile of it. But that didn't matter, because the economy was growing, right? This is how illusions harden into systems. Nobody saw the risk because everyone was profiting. Landowners were getting their rents paid in reliable paper. Merchants had liquidity to trade across oceans. The state had a permanent line of credit. Even the wars started to feel manageable, because war was no longer constrained by the treasury. As long as the bank existed, there would be money. This is the quiet shift that reshaped the world. Before the Bank of England, war was a fiscal event. A king had to raise taxes or melt down the family silver. After the bank, war became a monetary event, a matter of ledger entries, interest payments, and paper issuance. And so the national debt grew, from £1.2 million in 1694 to over £50 million by 1760. But no one panicked. In fact, many celebrated, because the debt was the money. What started as a workaround became a doctrine. Patterson's original rule that state debt can be used to back private credit became embedded in law, finance, and belief. Gold was still the theoretical anchor, but in practice it was the promises that mattered. We see this illusion in every booming system throughout history. In France, the assignats of the 1790s. In America, the wildcat banks of the 1830s. In modern times, bonds bought by central banks and quantitative easing. The belief is always the same, that if you engineer the right structure, credit can grow forever. That as long as people believe the paper is money, the paper is money. And that the debt behind it will sort itself out. Later. But belief systems don't last forever. They're strong until something shakes them. And by the late 1700s, the numbers started to catch up with the system. The gold backing was thin, the wars were longer, the debt was compounding, and a hard truth was about to return to center stage. Arithmetic cannot be deceived. If you're starting to see the parallels with our own credit-fueled world, drop a comment with the year you think this illusion will break again. Systems don't collapse because of bad intentions. They collapse when the numbers outrun the narrative. And in the case of the Bank of England's credit engine, that collapse came not with fanfare, but with silence. A silence in the vault. Because one day in 1797, there simply wasn't enough gold. Let's slow down and look at what happened. For over a century, the system had worked on paper. Parliament would borrow, the bank would lend, paper would circulate, and gold, well, gold was just the polite fiction that made people trust it all. But war changes fiction into accounting. By the 1790s, Britain was once again at war with France. Not the royal France of Louis XIV this time, but revolutionary France. A new enemy with new ideas. Anti-monarchist, anti-bank, anti-debt. Britain had to respond with money and lots of it. Warships, subsidies to allies, troops, intelligence, fortifications. So the government borrowed. Again. The bank printed. Again. But unlike 1694, people were starting to ask questions. Goldsmiths noticed something strange. Banknotes were everywhere, but gold coins were harder to come by. Merchants began quietly redeeming paper for specie, and foreigners, especially those holding British bonds, began requesting repayment in gold, not paper promises. Then came the run. In February 1797, a rumor spread that French troops had landed in Wales. It wasn't true, but it didn't matter. People rushed to the Bank of England, not to deposit money, but to withdraw it. Not to accept paper, but to demand gold. And when the vault doors opened, the clerk saw the horror behind the curtain. The bank didn't have enough gold to honor its notes. Let that sink in. The central institution of British finance, backed by Parliament and centuries of law, had overextended. The illusion had outgrown the collateral. The paper had outrun the metal. The government had two choices. First, let the bank fail and trigger a nationwide collapse, and the second, change the rules. They chose the second. On February 26, 1797, Parliament passed an order in council that suspended the convertibility of banknotes into gold. In plain terms, you could no longer redeem your money for anything real. It was called the Bank Restriction Act, a temporary measure, they said, just a stopgap. It would last 24 years. From 1797 to 1821, Britain lived under a paper standard, a credit-based economy without gold convertibility, the first full-scale national fiat currency regime in modern Europe. The fallout was immediate. Inflation, distrust, a surge in speculation. Prices of everyday goods soared: wheat, coal, cloth. The rich, who held land and bonds, adjusted quickly. The poor, paid in debased currency, suffered quietly. And while the war with France raged on, the war at home turned inward, into a class divide between those who understood the system and those who lived under it. But here's the real lesson. When the numbers exposed the limits of the system, the state didn't collapse. It adapted. It legalized the illusion. And this became the new doctrine of modern finance. When convertibility fails, credibility must be enforced by decree. It didn't end in 1821. That was just the reboot. Gold was restored, but the machine was never the same, because everyone now understood the truth. Paper isn't dangerous because it's worthless. It's dangerous because it works, until it doesn't. Every central banking crisis since has followed this pattern. The United States in 1933, gold convertibility suspended by Roosevelt. The Bretton Woods collapse in 1971, Nixon ending dollar gold redemption. Each time, the system stretched beyond its real reserves. Each time, convertibility snapped. And each time, the paper survived, by force of law, not by force of trust. So when you hear that the Bank of England is the model of prudence, the pillar of stability, remember this. In 1797, it ran out of money, not because of mismanagement, but because of design. Because a machine built to multiply debt will always run ahead of the gold, and eventually it has to choose between collapse or suspension of reality. And the same logic applies today. When central banks expand balance sheets to buy bonds, when governments issue more debt than GDP, when interest rates are held below inflation for years, it's not innovation, it's repetition. They did it in 1797 with banknotes and bullion. They do it now with digital reserves and bond yields. The only thing that's changed is how fast the illusion spreads. If you're still watching, you're one of the few who sees the crack in the machine. Drop a pin if you're starting to question what money even means. The Bank of England ran out of gold in 1797, but the world didn't end. In fact, a new one quietly began. That moment, when paper became money by law rather than by metal, wasn't just a patch to get through a crisis. It was a prototype for the entire modern financial system, a system we still live in today. We call it monetary policy. We call it liquidity. We call it quantitative easing. But the structure, the loop, is the same one William Patterson designed in 1694, exposed in 1797, and perfected ever since. Create credit, expand government debt, and enforce belief through central banks. If you're listening to this in 2025, you're living under that same rule. When you get a loan today for a house, a business, or your education, the bank doesn't hand you someone else's savings. It creates a new deposit on the spot. Money from nowhere, backed by your promise to repay. This is the modern version of the 1694 rule. Private entities can create purchasing power and be repaid in real labor, real assets, and real interest. That's why banks are powerful, not because they hold money, but because they generate it. And central banks, they play the role the Bank of England pioneered, buying government debt when the private market won't, setting interest rates to control belief, and acting like a neutral referee while quietly directing the game. During COVID, the U.S. Federal Reserve created more than $4 trillion in new money in under a year. The Bank of England expanded its balance sheet to nearly 40% of GDP. Japan's central bank now owns over half of the government's entire bond market. This is not stimulus. This is structural. It's a permanent merger of credit and currency, just like in 1797. And it creates strange realities. Governments no longer fear debt the way they once did, because they know their own central bank can always step in. Markets rally on bad news because it means more intervention. Asset prices rise faster than wages because newly created credit flows into stocks, bonds, and real estate, not into paychecks. We live in a system where the price of money is no longer set by savers and borrowers, but by policy. This is not capitalism in the old sense. It's something new. A hybrid of market freedom and monetary control. A world where governments borrow from themselves and pay interest to the entities they created. And yet, it works, at least on the surface. Just like in 1700, the illusion feels real because the loop continues. Governments borrow, central banks support the bonds, banks issue credit, people spend, taxes return, the cycle sustains itself. But there are signs that the loop is wearing thin. Inflation is back, not just in prices, but in expectations. People are starting to ask, where does the money come from? Trust is quietly eroding. Not dramatically, not like a bank run in 1797, but slowly, steadily, through every headline about deficits, debt ceilings, and currency devaluation. And at the center of all of it, the same rule remains. Money is not created by saving, it's created by lending, and those who control lending control the economy. Just look at who benefits. Every time a crisis hits, liquidity flows not to households, but to financial institutions. Bonds are bought, collateral is guaranteed, banks are stabilized, and ordinary people, they're given loans, debt, not ownership, payments, not profits. This isn't an accident, it's the structure. The system was built from the very beginning to serve the creditors because they're the ones who made the first deal. In 1694, it was £1.2 million for 8% interest and the right to issue notes. Today, it's trillions in bond markets, repo operations, and central bank liquidity facilities. The mechanisms have evolved, the math has scaled, but the logic hasn't changed. The Bank of England may have pioneered the system, but now it's global. The European Central Bank buys sovereign debt across borders. The Bank of Japan controls markets like a hedge fund. The Federal Reserve determines the cost of capital for the entire planet. And all of them operate on the same foundation, belief in debt, belief that it can always be rolled over, belief that central banks can always step in, belief that credit is money and that the music won't stop. But belief isn't infinite, it's elastic until it snaps. So the question isn't if this system breaks, the question is when trust will cost more than interest. And when that happens, the echoes of 1797 won't be academic, they'll be immediate. Because every illusion, no matter how well designed, eventually meets a boundary. In 1694 it was war. In 1797 it was gold. Today it may be energy, demographics, or digital alternatives. But the logic holds. A system built on promises can only survive as long as the promises are believed. You've seen it now. From a royal emergency in 1694 to a global monetary system in 2025. From a £1.2 million loan to trillions in sovereign debt. From gold in a vault to digits on a screen. But don't mistake this story for one about numbers. It's a story about belief. Because in the end, money isn't about coins or paper or reserves. Money is agreement, enforced by law, backed by power, and managed by those who write the rules. And the rule that emerged in 1694 still runs the world. Debt, when guaranteed by the state, becomes money. Not when it's paid back, not when it's earned, but the moment it's issued and believed. This was the original financial alchemy, turning promises into currency, and currency into control. The empire that grew around it, the British one, then the American one, wasn't just powered by armies and ships. It was powered by credit. Credit that could expand faster than gold, faster than labor, faster than the truth. We are told today that central banks are neutral, that they act in the interest of stability. But stability for whom? Because when the numbers don't add up, when debt piles faster than growth, when inflation rises faster than wages, the solution is never to change the system. The solution is to enforce it. Suspend the gold, repress the rates, stretch the illusion. This is the warning buried in history. When a financial order becomes too complex to question, too sacred to audit, and too big to fail, it doesn't reform. It protects itself until it breaks. And when it does, it won't be because of a villain. It will be because arithmetic quietly outpaced the narrative. So remember this. Systems don't collapse because of bad intentions. They collapse when the promises outgrow the trust. And in the end, trust is the only real collateral a civilization has.